It's really out of whack. So this is a very delicate situation here. The good times have ended through all this easy money printing, and now we have to start facing reality and what the true economic conditions are. And I don't think they're as bright as the expectations have been set forward.
Welcome to Inside the Markets, flagship podcast, thestockpulse.com. Joining me today, Peter Spina, owner-operator of GoldSeek.com and SilverSeek.com. Peter, thanks for taking the time here. I know coming to me from Prague there in Czechoslovakia, so thanks for doing that. And it's certainly been a while since we've spoken, so I guess let's get right into it here and maybe give us a big picture view of how you see the whole economy. Kind of a loaded question here, but let's start there.
I believe the last time we spoke, we were going through, the midst of this grand bazooka liquidity injections by central banks around the world. Gold had its initial strong response. It rallied among the fastest and quickest. And then for the last year and a half, it's been this miserable consolidation period, watching all these other commodities just go ballistic, and watching these stonks or crypto bubble or all these different, real estate, everything is going up, but gold and these mining stocks just getting sold off. So it's been a frustrating period watching this consolidation and watching how all this money creation and all this inflation is brewing in the system. But I think what the key thing that's shifted recently in the last maybe 2-3 months is this view of inflation being transitory and managing the expectations, which was really the Fed and central banks' key tool in their toolbox, which is to run this propaganda, disinformation campaign, making people believe that they can create something out of nothing, all this, expand the money supply, cut rates, all inject all this liquidity and not see a reaction to it. So they knew that they really loaded up the system with liquidity and easy credit and pumping things up, and the inflation is working its way through. And now people, they can only hear the same story for so long before they wake up. Going to the grocery store every month, prices keep going up. The gas prices are going up. It's not just your assets. It's not just real estate and your stocks that were going up at first, which made you feel very rich. Now it's the things that you need and have to spend money on, and your disposable income is shrinking and your standard of living is decreasing. So people have now started to really feel the effects of inflation. They're going to get a lot more angry now as things get more and more expensive, and this is causing gold to react. I think a lot of big money has woken up. There's been some big buying going into gold. Physical demand has been very strong in the key centers as well, but it's really the Western buyer when the hedge funds and these guys come back into the market. And for the last year plus, they've been selling off. They've been dumping their gold ETFs. They've been just chasing everything else. So the inflation rate is really taking off. The yields are rising, but the real yields are going, remaining in deep negative territory, and the expectations of how high the rates can rise at this point. I think the wake up call has hit, and now with the gold price breaking out through some, a key technical barrier, I really believe the gold price has broken out of its consolidation period, and it is undergoing a big breakout at this moment.
Yeah, let's tackle inflation here. Fed's obviously telegraphed they're going to raise rates, tighten things up here. I don't know. I've heard a lot of things here. A lot of things could break. I guess lay this out for us here. How does this look with rate hikes? And to Peter Schiff's point, maybe, are they even going to be able to do it? So how do you see things going here for 2022?
It's a difficult position the central bankers are in. They put themselves into a very difficult spot. They use a lot of ammo in the past during past financial crises, and they quantitative easing. They cut rates to such a low point that they're painted in this corner. Now, all of this stimulus was supposed to respond with this really strong economic growth, and which it has initially, but that was a lot of pent up demand, from the lockdowns and everything coming back online. But there is a big economic hole from the last few years through this COVID situation, and it's becoming other things are happening, which we don't need to really talk about, supply chain issues and the vaccine mandates and other things that are adding pressures to it, energy crisis and all this. It's a lot of things are converging right now. So the rates rising aggressively, that will trigger another financial crisis. It starts to implode debt. You'll start to see some major problems if the rates really start to rise. The whole system is just levered up. It's just it survives under a condition of easy credit, easy money. Now, if rates go up, it's just going to burst all these bubbles, and that is a much larger threat. So the Fed, then they may say they have a 2% maximum inflation rate. They're willing to take a much larger, higher amount inflation if they can get away with it. But now it seems like, the market's starting, bond traders and others are waking up to this. So they're going to have to let rates go up some level. I don't think they can do more than a few percent. Then you start to have some real serious issues from, even from the government's standpoint of paying interest on their debt and ongoing deficits and financing that. So there's a real limit to where these rates can go up without really imploding the system. So if rates were really to get out of their control and go up to 5, 6, 7%, those are rates that are unimaginable to what the consequences, in this whole basically Ponzi scheme, this financial Ponzi monetary debt scheme that's been created. So, eventually there's going to be something that breaks it. Is it going to be, uncontrollably rising rates, or are they going to cap it? Is there going to be initial deflationary period coming up, which I believe maybe it's a year or two down the road where they do have rising rates and liquidity gets tightened and they're trying to deal with this inflation problem. And that deflationary, that pool is going to return, or it's going to be responded with a very aggressive another round of quantitative easing and rates and all this stuff. So yeah, it just seems like they're just buying themselves more time, and never addressing the problem. Debts, deficits, everything just keeps getting more and more absurd. Everything gets further and further away from the equilibrium. And the manipulators have done an excellent job of messing up the free markets. There's no price discovery. No one really knows what's true, what the real prices are. So the whole system, it's really out of whack. So this is a very delicate situation here. The good times have ended through all this easy money printing, and now we have to start facing reality and what the true economic conditions are. And I don't think they're as bright as the expectations have been set forward.
Yeah, let's get into maybe how to play the sector here. Certainly a lot of ways to do it, maybe no right or wrong. Maybe give investors a little of your philosophy here. There's certainly a physical game, there's a paper game, and there's a stock game. So how does Peter Spina play?
Yeah, I start off with physical. The core of any holding and safety is physical. Hold it in physical ownership as much as possible. I mean, I spread out my holdings in different ways. I do like using different vaults and so on, but holding ETFs and these paper derivatives can be very, very risky. And that's not the point when you're buying something which is supposed to protect you. You don't want to take on these additional risks. So the bullion is an excellent, gold it may not make you 200-300% here, like like you see in some of the crypto and these other markets that are popping, but it's not going to collapse and you're not going to lose 50% overnight either. So, for those who are looking at it, set some realistic expectations, especially with gold. It can run to $2,500 this year. It can go to 3,000, which is a very healthy return. But the real upside potential remains with silver. That is like a high beta gold stock. Silver has all the conditions it needs to make a serious run. There's been some serious physical demand, industrial and monetary interest, where investors have come back into the market. We've seen a huge gap from maybe 2014, 15 or so into the last few years, where physical silver investment just collapsed. People were running after crypto, all these other things, and now that's changed. So what we're looking at this year is silver. Anything in the low to mid 20s just seems like a steal. If you can even obtain the physical metal near those spot prices, you're gonna be paying pretty hefty premiums. So, the next best option to physical, to exposure to the physical and silver is the mining companies, which have had some really good quarters, a few years here of really high metal prices, and gold and silver are very good margins, especially on the gold side, to really improve their balance sheets or cash positions. They're much more efficiently run and managed, so they're a lot more compelling. The valuations are very low right now, and they have fallen really heavily. A lot of them have fallen by half. Major mining companies from their highs from 2000. I guess that was in 2020 in August there when gold was peaking, and then mining stocks after it. So, yeah, the gold stocks ratio, the gold stocks to gold ratio is severely favoring the gold miners right now in gold stocks. Same thing with silver. So if we're in a breakout mode and you're willing to take on some more risks, although I don't see the risks being too high for the mining stocks at this point, I think you do very well with the mining companies right now. For silver, the technically we're looking at 25-26 as its first initial resistance. I think we're going to get up there and through it pretty quickly, and then it's going to be playing around up there and looking at that $30 mark, which we hit about a year ago. And once silver really gets up towards 30, I think with gold also on its way higher, there's just going to be so much momentum, people jumping back in with limited supplies out there, that you can get a real bidding war out there like we've seen with other commodities. So silver breaking through 30 has really good potential for this year. And once we break 30, I think you're going to see a lot of people piling in. And silver is such a tiny market with a very concentrated short position. So silver jumping to 50 from 30, it doesn't seem like a very difficult task. So there's a potential that breakout occurs this year. If we continue to see this kind of washing machine action, which we've been seeing the last year and a half, where we just see this, up and down, up and down, up and down. It's great for traders, but I really believe that game has ended. That as I said, the rules have changed. The market is now looking to make a serious move. The wake up call has been given, and now it's a gift if you can get a pullback. But I don't think gold is heading under $1,800 at this point. Silver in the low 20s. That looks like it's also going to be a difficult buy. I think those days are over. So I hate to chase things. It's not fun to pay up. But look at the overall valuations of the mining companies, how far they've come down. Especially with the mining stocks, you're not paying up right now.
Yeah, let's get into the juniors here. Certainly a slippery slope when you're playing with them. Do your research on these folks. I don't give any advice in this sector. I do know it's a good way to get some leverage here. So how do you see things here? I know a lot of capital entered the sector here to do a lot of exploration. So did that exploration turn into discoveries? Maybe break down the sector here for investors.
Yeah, it depends on which companies. There's a lot of these lifestyle management companies in Vancouver that unfortunately have been mining the investors, but there's been some really solid ones. I think like you said, the benefit has been that the huge cash inflow into the juniors, into exploration companies, has allowed them to re-engage in development work, exploration work, which has been shut off mostly for many years during this drought. And the sector needs it desperately. The big mining companies have not been making big discoveries. The larger companies are looking to make acquisitions. We've seen some of that occur, but I think the exploration companies, depending, you have to be careful which ones you pick. There's some excellent choices out there. The ones that have come down also 50% or more from their recent highs over the last year, who have good cash positions, who have been advancing their projects, who are releasing some really great drill results, adding value by adding ounces and upgrading these projects to closer points towards decision points of production points, or towards production. So there's been a lot of value being created, and that's going to be recognized more in this run. The last run, yeah, it was the prices of these exploration stocks are so dirt cheap that it didn't take a lot to really shoot them higher, and then the money came in, and now the money is being put into the ground. So it's great to see these results coming out, and some companies making some great advancements with this capital that's been infused.
Yeah, I think you said it though earlier. There's probably a good buying opportunity here. A lot of them have been have been taken behind the woodshed, if you will, here the last year and a
Yes.
half. So
There's no liquidity down here. The second you get some real buying energy, the amount of share availability is nothing. All you have is some really weak, beaten down, old time holders. And I get it. We like I said, we've been beaten down. We've been waterboarded. We've been taken through this horrible period. We're just so used to getting smashed and never seeing these rallies last. So people have been conditioned and trained to give up, to give up on a quick rally and so on. So you get a little bit of a shakeout here, but over the last year and a half, so many people have been just squeezed out and given up and left. So there's not a lot of supply down here. So when this energy in this market really comes in, which looks like it's starting now, it's not going to take a lot for these exploration stocks. It's not just shoot up 10, 20%, but a lot of them can go up 50% in a very short order, and they still be below their highs from last peak last season.
Okay, we'll leave it there and look forward to having you back up here and go over some of those predictions. So, and that was Peter Spina. He's the owner operator of GoldSeek.com and SilverSeek.com. So, Peter, certainly appreciate the time. And yeah, hopefully we can get you over here to get to the next Silver Symposium here in 2022 in August. So, again, thanks for the time and look forward to checking back in soon.
Thanks, Rob, and I hope to get over to your event this year. It's the Silver Symposium. That's an excellent place to hold it and a great place to meet with mining companies and investors. So that's one of my main goals this year, is to get over there and participate in this conference, especially in the silver focus side. I really believe the upside in silver and the potential has arrived. There's so much going for us, so I'm quite excited for that. And